That number on your screen, gold touching $5,000, it's not a victory lap, it's a warning label. For anyone watching that price climb with a mix of awe and anxiety, you're asking the right question. Did I miss it? Is this just a bubble? Or most importantly, what is this actually telling me? This is Currency Tea. Today, we are going far beyond the daily charts. We are going to decode that $5,000 signal. This isn't a simple story of supply and demand. It is the direct result of three irreversible historical forces converging. By the end of this, you will understand not just why gold is here, but where this path inevitably leads, and what that means for every single dollar in your wallet, your bank account, and your future. And the first force isn't about economics, it's about trust. And we are about to witness what happens when that trust finally completely evaporates. But let's start with the feeling in the pit of your stomach, the feeling that something is off. You work, you save, you're told that's the responsible path. Yet the goalposts keep moving. The down payment for the house gets bigger. The grocery bill does the silent creep. Your cash, parked safely, seems to be softening. That feeling is your rational mind confronting a broken promise, the promise that a paper currency is a stable store of value. For the last 50 years, since the final link between the dollar and gold was severed, we have been living in a global experiment, an experiment in pure faith-based money. Fiat currency. It has value because the government says it does, and because we all agree to believe it. And for decades, it worked well enough. Growth was strong, the world order was stable, the money printer was used sparingly. But an experiment has a hypothesis, and ours was, can we manage infinite growth and debt on a finite system of trust? Look at the debt, not just government, but corporate, consumer, it's a vertical line. To service that debt, to keep the system from seizing, there is only one politically palatable tool: more currency. They don't call it printing anymore. It's quantitative easing. It's stimulus. It's liquidity support. The Federal Reserve, the ECB, the Bank of Japan, their primary function has morphed into something not to protect currency stability, it's to prevent the debt tower from collapsing. And every time they choose to create more digital dollars, euros, or yen to paper over a crisis, they dilute the value of every single unit already in existence. You see it in official inflation numbers, which are debated. You feel it in real prices, which are not debated. Your cash isn't earning a paltry 3% in a savings account, it's losing against a real inflation rate that could be 5%, 7%, or more. You are being taxed without a vote, a silent, perpetual tax on everyone who holds the currency. This is force one, the fiat endgame. The experiment is now yielding its result: managed decline. But here's where it gets dangerous. This isn't just a domestic issue. The whole world has been holding the same experimental paper, and after 2022, they started reading the lab report. The weaponization of the dollar reserve system was a geopolitical earthquake. Overnight, hundreds of billions in assets held by a nation-state were frozen. The message to every other country, friend or foe, was crystal clear. Your reserves are not your property if they are in our system. They are a political tool. Think about that from the perspective of a nation like China, India, Saudi Arabia, or Brazil. For years, they've traded real goods, oil, manufactured products, resources, for digital IOUs that can be turned off, IOUs that are being intentionally devalued by the issuer. What would you do? You would quietly, systematically start swapping those IOUs for something that cannot be frozen, something that is no one else's liability, something that has been real money for 5,000 years. This is force two, the global run on promises. Central banks aren't speculators. They are the ultimate, slow-moving strategic elephants, and for over a decade, they have been net buyers of gold. Since 2022, that trickle has become a torrent. They aren't buying gold because they think it's a cute investment. They're buying gold because it is the antidote to the systemic risk of the fiat experiment. They're de-dollarizing their reserves, and gold is the only asset large enough, neutral enough, and proven enough to fill the void. This isn't conspiracy. It's public data from the World Gold Council. It's the most significant shift in the global monetary order since 1971. and it creates a bidding war for a physical asset that cannot be digitally reproduced at the click of a button. Nations versus investors versus everyday citizens, all scrambling for the same tangible lifeboat. So we have a failing system and a global flight from it. But why does this lead to a supercycle and not just a price bump? To answer that, we must open the history book, because we are not the first to stand at this exact crossroads. Every single fiat currency in history, every single one, has eventually returned to its intrinsic value, zero. The Roman denarius was debased with copper. The Weimar poppy mark was printed into oblivion. The cycle is always the same. Debt rises, money is created to hide the pain, trust erodes, and people flee to real things: land, commodities, and always, always, gold and silver. We are not in uncharted territory, we are in well-charted territory. The chart of the US money supply expansion now mirrors the early stages of historic hyperinflations, not in magnitude, not yet, but in trajectory. This is what a currency supercycle looks like at its inception. It's not gold becoming more valuable in a vacuum. It's the measuring stick, the dollar, shrinking against everything real. The critical, terrifying difference between now and Weimar Germany, or Zimbabwe, or Venezuela is scale. Our global economy, our debt levels, are magnitudes larger, tied together by a digital web. This brings us to Force 3. The trap that makes the outcome of this experiment a near certainty. The debt trap and the point of no return. Let's talk about interest rates, the supposed brake on inflation. In the early 1980s, the Fed, under Volcker, jacked interest rates to 20% to kill inflation. It worked. It also caused a brutal recession. But the US debt to GDP ratio then was around 30%. Today, it's over 120%. You cannot raise interest rates meaningfully in a world drowning in debt. Why? Because the government's own interest payments would explode. The budget would collapse, corporations loaded with cheap debt would fail, the housing market would seize, the system would break. So what's the only possible path forward for policymakers staring at this trap? They will always choose more currency creation, more liquidity. They will let inflation run a little hot. They will talk about cutting rates to support the economy. They will do this to avoid an immediate painful collapse. But this choice is just a slow motion version of the same collapse. It is the death of the currency's value by 1,000 cuts. This is why gold at $5,000 isn't a top. In this supercycle, gold isn't tracking inflation. It is tracking the discount rate on the future value of the dollar. The world is starting to price in the inevitable conclusion of the 50-year experiment, a permanent state of monetization. So, is it too late for you? Let's reframe that question entirely. It's not, is it too late to buy gold? The real question is it too late to move a portion of your wealth from a depreciating liability to a timeless asset? Gold isn't going up. Your currency is going down. This isn't about becoming a gold bug or selling everything you own. This is about understanding the fundamental role of different assets in your portfolio. Your cash is for transactions and immediate needs. Your investments are for growth and yield. But what is for preservation? What is the portion of your wealth you want to be sure is still there, with its purchasing power intact in 10, 20, 30 years? That's the role gold has played for millennia. It's not a stock that goes to zero if a company fails. It's not a bond that can be defaulted on. It's not a currency that can be printed into worthlessness. It's simply physical, dense, immutable wealth, no counterparty risk. Now, you might be thinking, but what about stocks or real estate? Don't they protect against inflation? Absolutely, they can, and you should own them for their productive potential. But let me ask you this. In a true currency crisis, what happens first? Liquidity dries up, markets freeze, everything sells off initially as people scramble for cash to pay bills. But then, as the reality of currency devaluation sets in, capital doesn't flow back equally. It floods into the most trusted real assets, productive farmland, energy, and yes, monetary metals. Gold's unique advantage is its universal recognition as money. It's the final backstop. A rental property is a great inflation hedge, but it's illiquid and local. A share of the company is a claim on future profits, but it's tied to that company's fate. A gold coin is recognized as value itself, globally, instantly.
Consider the hierarchy of safety in a monetary reset. Essential goods like food and energy come first, followed by monetary metals like gold and silver, then productive real assets like land and infrastructure. Then sound foreign currencies. Domestic fiat currency and financial paper like stocks and bonds are at the bottom, facing a volatile transition. Your personal pivot starts with this mental shift, allocating a portion of your savings from the bottom of that hierarchy to the top. Let's bring it home. The $5,000 signal. Force 1 is the fiat endgame. The 50-year experiment is in its failure phase, characterized by perpetual currency devaluation. Force 2 is the global run on promises. Nation-states are ditching paper IOUs for neutral, physical gold, creating massive structural demand. Force 3 is the debt trap. The sheer size of global debt makes honest interest rate policy impossible, guaranteeing more money printing. This is the supercycle. It's not a